Starting late with investing? Here's a simple 3-fund setup you can use as a calm starting point, and the exact rules that keep it hands-off. Example only. 60% a broad S&P 500 index fund, or ETF, as the foundation, 20% QQQM as a growth tilt, and 20% SCHD as a value/dividend tilt. This isn't a prediction or a promise. It's a structure. One core, one growth sleeve, one steady sleeve, built for consistency. Quick note, this is educational, not financial advice. I'm not a financial advisor. Do your own research before buying anything. Now let's make it practical. Step 1. Pick the foundation. Your foundation should be boring on purpose. A broad US index spreads you across hundreds of companies, so you're not betting your future on one stock or one sector. For late investors, boring is powerful because boring is repeatable. If you're choosing between an ETF and an index mutual fund that track the same index, focus on what you'll actually use. Low costs, simple access in your account, and ease of recurring purchases. Step 2. Add a small growth tilt, not a growth obsession. QQQM is more concentrated and can swing harder than a broad index. That's why it stays smaller in this example. If you can't hold it through a drop, skip it. Your plan should create calm, not demand perfect calm. The goal is staying invested, not proving toughness. Step 3. Add a steady tilt with a clear purpose. SCHD is often used for dividends and a value-leaning basket of companies. It won't remove risk, but it can diversify how your portfolio behaves. Different behavior can reduce the urge to panic, and that's a real edge for late investors. Step 4. Decide your contribution number before you pick your perfect fund. Start with what you can repeat. $25 a week, $50 a paycheck, $100 a month, whatever fits your life. Consistency beats intensity. If you increase later, great, but don't start with a number you can't sustain. Step 5. Automate the boring part. If you use Fidelity or any major broker, set an automatic transfer on payday or once a month. Then, if your platform supports recurring investments, set recurring buys into your chosen funds at your target percentages. If it doesn't, make it a 2-minute routine. Transfer, then place 3 simple buys on the same day every month. Same date, same plan. No improvising. Step 6. Use a rebalancing rule so you don't tinker. Your target is 60-20-20. Markets move so your percentages drift. That's normal. Check only quarterly and only rebalance if a slice is clearly off target. Rebalancing is not about being perfect. It's about keeping risk where you intended. Step 7. Know where this fits. In a retirement account like a 401k or Roth IRA, you're usually aiming for long-term growth and tax advantages. In a taxable brokerage, you also care about taxes, so staying simple and avoiding constant trading matters even more. The less you touch it, the cleaner it tends to be. Step 8. Write 3 guardrails and follow them like a contract. I contribute on schedule. I don't sell because of headlines. I don't add new funds unless I can explain the purpose in one sentence. That's protection first, simplicity second, and growth as a byproduct of staying invested. If you're starting with a small balance, that's normal. I started late too, and I'm building with consistency, not ego. If you want, I'll share monthly updates, wins and losses, so you can see what calm investing looks like in real life. And if you want the next step, subscribe. Next, I'll show how to choose between brokerage, Roth, and 401k, and how to adjust risk as retirement gets closer. One more thing. This is a starting framework, not the only right answer. Some late investors also include an international fund or a bond fund depending on their risk tolerance and timeline. If adding another fund makes you confused or tempted to tinker, don't add it yet. Earn the right to add complexity by proving you can follow the simple version for a full year. And if you're watching this while carrying high-interest debt or no emergency cushion, consider stabilizing those basics first so you're not forced to sell investments at a bad time. Your investing plan should fit your real life, not an ideal version of you. Here's the simplest maintenance routine. Once a month, confirm the transfer happened. Once a quarter, check your allocation and rebalance only if it's clearly off. Once a year, review your contribution amount and raise it if your budget allows. Everything else is noise. Quick recap so you can screenshot it. Foundation 60% broad S&P 500 Index Fund or ETF. Growth Tilt 20%. QQQM. Steady Tilt 20%. SCHD. Automate contributions. Rebalance quarterly only when clearly off. Follow your 3 guardrails. That's the Late Investor version of simple and calm. Like and subscribe for more of the Late Investor.